The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So we all have regrets about things in life. Some of them we could have controlled, and some of them were out of our control. One of those things that often is out of our control is the stock market.
Often.
My wife asked me today, she said, "Don't you wish you had a crystal ball that you could actually see something in?"
Yes, that would be marvelous. He is correct.
Yeah,
Yes.
she said that while I'm eating breakfast with a mouthful of food, and I can't respond to her. So I just waited for the subject to change.
Uh,
But the most common approach to the stock market in today's financial services industry is the balanced portfolio.
Indeed. Yep.
For most people, that means that they have somewhere between 40 to 60% of the money either in stocks or in bonds. That combination kind of moves back and forth depending on how they answered personal risk evaluation questions that had nothing to do with risk of the stock market,
Right.
just simply had to do with how I feel about losing money in the stock market. Of course, that answer for virtually everybody is, I don't want to do that.
Nobody wants to
That's a
lose money in the
stupid
stock
question.
market. It is. It's a stupid question, and it's a stupid way to approach it. We believe all of those questions are assuming that the risk is in your opinion. So we need your opinion to set where your portfolio is going to be, instead of asking what's going on in the market. That's what's actually important. But the risk questionnaires are always focused on what does the investor feel about things, and so the risk is in the person. And we always think that's backwards.
What happens is the answers that you provide go through a predetermined evaluation. Each answer has a certain number of points assigned to it. And after the the questionnaire is completed, those points are totaled up. And that pegs you into typically a balanced portfolio. Almost
Correct.
everyone ends up in the middle range, somewhere either side of 50-50. And what does 50-50 leave you with? 50% of the time you're happy in stocks. The other 50% of the time you're happy in bonds. And you're never quite sure why I'm here when the other side is working. Isn't that the way you feel about it?
It's funny how that works out, that the market never lines up with that. It's never a 50-50 market. You're always feeling like, oh, I should have more stocks now, or I should have less stocks now, or more bonds now, or less bonds now, because that's the nature of the market. And saying that, well, I'm just going to have this static mix and I'm just going to hang on to it no matter what, is basically how your financial advisor gets out of doing any work. And saying, well, I'm just going to leave them alone, and we're going to keep calling them as often as we need to keep them invested, but we're going to try to make sure that they have enough of everything that at least something is going to be going up most of the time, but everything's never going to be going up. All the time, and then everything's not going to be going down all the time. So we're just going to live with it, and you just walk away. You just ignore it after that, and we think there's a better way to do that.
Well, and basically the financial advisor role is to hold your hands and remind you you're in here for the long term.
Right.
Even if you're in your older years, the long term is now your children and your grandchildren. It's your legacy money. So
Correct.
It really doesn't matter that something's not working at the present time. It reminds me of one of our professional associates who was interviewing a prospective client who had come in for a portfolio review. And if, by the way, you would like us to do that with you, we'd be glad to do that too. That's a freebie that would take a look at your portfolio and give you our sense of whether or not you own leaders or laggards in your portfolio and what your choices are. In any event, this particular prospective client had a large position in HP. As a matter of fact, it's a big company. It's a big
Sure.
firm. I love HP printers. I mean, I've been through all sorts of other kind, but I love their product. But at
Yep.
the time, his position was substantially below his cost, not just a little bit, substantially. And our friend said to the prospect, "Why do you have HP in your account?" He said, "I don't know." "Well, let's call your broker and find out." So they
Why do
got
you
on the
own that?
phone and they called his broker, major Wall Street firm, and said, "Hi, this is Jack, and I'm here with your client Joe, and we've got a question for you." Joe's got a question. Joe said, "So why is HP in my account? Because I'm down big double digits in return."
Right.
And the broker said, "Well, HP's a good American company, and everybody should own a little bit."
There you
Frankly,
go.
that did not make the client happy. So that broker got fired because he was not sensitive to the risk of losing money in the account. And that's
Right.
basically the problem with balanced portfolios. There is no real concern with monetary losses. The
Correct.
assumption is everything will eventually come back up. So we just wait it out. After all, the implied assumption is you don't need the money. That's why you have it in the account. That's why we're sitting on it, because you don't need the money, and we are your watchman on the wall, basically. We're taking care of you. We're answering your questions. But don't worry, it's a good American company and should be in your account. Well, that's the way bonds are. Everybody
Right.
should own some bonds, even though we're now in our fourth year of losing money in the Barclays Aggregate Bond Index, and in the longer term, the TLT, the 20-year Treasury
Right.
ETF.
Right.
These are losing money year after year, and yet the bond portfolio of your account is basically, well, that's what everybody does. You should too.
Right. I like the analogy that those balanced portfolios, it's investment Prozac. It's like, yeah, we know everything's down, but we don't care. You just don't care about it. You're going to ignore it. That's the whole idea, to get you to not really take a look at it, and especially don't look at the alternatives. There was a better way to put this together for right now, and we could have done that, but instead we're just going to leave it alone. We're going to say, yep, those losses are significant, but in time, who knows how long that is, they'll be okay. And so we don't have to care about it. And then we don't have to do anything. And it makes the advisor's job much easier that way. And you're supposed to just not look. That's the solution. And we just don't think that's good enough. There's a better way to take a look at the market and say we should be in this part of the market, or we shouldn't be in this part of the market right now, and look at those trends and follow them instead of just ignoring what's going on in the market.
This is not a new concept. The market has always
True.
worked its way through the existence of leaders and laggards.
Yeah.
Depending upon where we are in the business cycle, some companies do really well because there's high demand for their product and services. And at the same time, there's other companies in that same part of the business cycle where there's no or little demand for their products and services. Yet the balanced account says it doesn't matter. We're going to own leaders and laggards universally with equity. What a great idea. Why
And
not
it is.
focus on the leaders? Pay attention to the laggards, and when they're not working, let's get them out of the account.
And,
Uh,
and that's a better way. That's a better way, in our opinion. It just takes more work. Your advisor has to be paying attention all the time. And instead of saying it doesn't really matter what returns are right now across the board, we're going to own that little bit of everything, and we're just going to continue to, no matter what. And if emerging markets are losing money for a decade, we're just going to keep losing money there for a decade, because sooner or later it'll turn around. And when you're looking at 70, 80, 100-year averages, you don't care anymore. That's just not real world. That's just not what people need in their lives, especially if you're already in retirement. You don't need somebody to tell you, well, in 25 years, this is all going to be fine. That doesn't matter. That's not your time frame. And so you need to be a little more proactive, we believe, and look at what's going on in the market and make those adjustments. And it's not, we're not in there, three times a day changing where your investments are. The trends are bigger than that, and it's easier to follow the money, make that change, and it gives you a better opportunity to be on the right side of those trades and be more in sync with where the market is now instead of where the market was 5 years ago.
Well, you mentioned the 20 or 25 years out because you don't need the money right now. But what if you
Right.
do need the money out 25 years and you're young enough that 25 years is acceptable, but that 25 years happens to be the fifth year after the tech bubble bust again,
Right. Right.
or after the great financial housing collapse, and it's 3 years, 4 years after that peak? That's where your 25 years is, and nobody did anything to protect the capital through those 30, 40, 50, 60% declines.
Correct.
Well, that's where paying attention to laggards is critical to your financial well-being. Does that make sense? We think it does.
It sounds very simple, and it is. It's just that it's not easy. It's not easy to make those adjustments. It's not easy to stay on top of where things are going. But the concept is simple. If things are going up, buy them. If they keep going up, hold them. But when they start going down, sell them. Don't just sit on them and watch all your losses that you may have accumulated for years walk away because something has fundamentally changed in the market. When it does, adjust to that. Be adaptable, and that's our philosophy. Adapt to the market, and don't get stuck married to a single asset allocation model, because that's not the way the world works, and it's not the way your portfolio is going to be best for you. You need to avoid some losses if you can, and quite often you can. Not always, but very often you can get out of the way of a declining market.
It's hard to recoup lost capital. Anyway, if you
Sure.
would like a second opinion or a third opinion on your particular portfolio and holdings, contact us. Phone number and email are on this follow-up screen. Subscribe to our websites. We have a webinar coming up this next weekend. Register for that. And thanks for your time today. Have a great week.